Hello, and welcome to the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinion of ADM Investor Services or Archer Daniel Midland. Today's guests are the ADMIS research team of Mark Bowman, Mark Soderberg, and JP Steiner. Starting with energy markets. Mark, how is the closure of the Strait of Hormuz affecting the natural gas prices?
Well, it certainly has sent international prices sharply higher, but the reaction in the U.S. market has been more than subdued. Qatar is one of the world's largest producers of LNG. They represent about 20% of global supply, and the closure of the strait has blocked their export path, and that's caused them to halt production. However, U.S. produces most of its own supply for the most part, and U.S. LNG exports. U.S. is the largest exporter of LNG in the world, but we're already close to peak capacity, which means the U.S. market is at this point fairly insulated from the global supply turmoil. On Friday, LSEG estimated average gas flows to the 9 big U.S. LNG export plants, reaching about 18.1 billion cubic feet per day so far in March, still a bit short of the record 18.7 in February. There's also a new 2.4 billion cubic feet per day export plant under construction in Texas, which is ironically a joint venture between ExxonMobil and Qatar Energy. That plant is undergoing testing and is expected to start producing its first LNG in the coming weeks. This will help a marginal increase in demand for U.S. LNG. On top of this, one of the things driving the world situation, the global situation, is European supplies are already drawn down before this crisis started, and they will need to import as much as they can this summer to prepare for next winter. And even if the strait were to reopen today, it could take some time to get up and running. The question is, will Europe consider removing sanctions against Russia? And for that matter, would Russia allow exports to Europe to resume? Persian Gulf is also a big source of fertilizer, which is made from natural gas. And the higher gas prices, the blockage of the strait, could also have a significant impact on the global agriculture.
Sharply higher energy prices have for sugar.
Okay, so one thing higher gasoline prices do is they increase the incentive for they boost support ethanol. And this will increase the incentive for sugarcane processors to dedicate more of their crushing activity to ethanol production at the expense of sugar. Now, Reuters did a poll of traders and analysts last week, and they had the average guess for sugar share of crushing in Brazil's center-south region, which is their main production area. They had that number falling from 50.7% this season to 48.8% for 26-27. Not a substantial change, not some wild, crazy move, though. They really don't have that much leeway. Now, we've already seen some evidence of the switch in the biweekly UNICA reports on Brazil's production. But up to now, those moves mostly attributed to low sugar prices more than high energy price costs. But we can see where the high energy prices can support a sugar rally. Brazil's 26-27 officially begins at April 7th. We've also seen kind of a shift in expectations from a surplus, well, basically from expectations from a large surplus last year to a smaller surplus this year, now to a smaller surplus this year to a deficit next year in global production. And this has been kind of a change the last couple of weeks, possibly driven by reductions in Indian production forecast for 25-26 after they saw some inclement weather last fall. And also we have this threat of El Nino this summer. But at this point, it could be speculative as the U.S. Climate Prediction Center is expecting conditions to stay neutral through the North American summer. We also saw raw sugar prices weaken last week on concerns that a sugar operator in Dubai, which turns out the largest port-based sugar refinery, they're with the strait block, they would not be able to import raw sugar, refine it into whites, and then export it. So this would have lowered the demand for raw sugar. Now, the company claims it's operating normally, and then it can use import and export facilities outside the strait. Also, sugar being one of those commodities dependent on fertilizer for production, both cane and beet. And so the increase or lack of supply of fertilizer threatens to lower production overall.
To Mark Soderberg, outside of volatility in the energy markets, what will drive prices in the ag space this week?
Yeah, very possibly not much. Historically, there is a very strong correlation between heating oil and soybean oil futures, as long as in addition to RBOB and corn prices. So as contracts across the energy space have soared to multi-year highs due to this war in Iran, prices across the ag space have also spiked. Spot corn prices reaching a 10-month high here overnight, soybeans a 2-year high, and soybean oil having reached a 2.5-year high. Energy prices, they inched up here overnight, but they are well off the overnight high. So as a result, agricultural prices are backing up as well. We do have a USDA WASDE report tomorrow. However, the markets do not expect significant changes in the U.S. balance sheets. Corn exports remain very strong, but the USDA is already forecasting record shipments at 3.3 billion bushels. So I don't look for a change this month from the USDA, taking a pause to wait out the weather another month here in Brazil, as weather there takes on added significance with the planting of their second crop nearly complete. I do look for a 25 million bushel cut in demand for the production of ethanol, resulting in ending stocks up by that amount. For soybeans, it's hard to envision additional sales to China, as Brazilian supplies they're running about $1.25 to $1.50 below U.S. offers at the Gulf. That said, however, U.S. Treasury Secretary Bessent and U.S. Trade Representative Greer, they're scheduled to meet with Chinese trade officials this weekend in Paris ahead of the President Trump trip to Beijing later this month, where he's going to meet with Chinese leader Yi. I do look for a 10 million bushel cut to stocks due to higher crush. Crush margins have recently soared to multi-year highs, driven by the soybean oil surge in price. The current USDA production forecast in South America seem very close to what many of the private estimates are. So I don't look for a big change in the global S&Ds as well. But speculative traders, they've just been pouring massive amounts of capital into the long side of the ag futures here, fueled by inflationary concerns. At some point, however, I think this is going to start leading to much greater demand destruction.
What we've been seeing from the index funds in the recent weeks.
Yeah, index funds are often used by asset managers as a hedge against inflation. They've been active buyers here in the ag space here for 5 consecutive weeks. That's taken their long position in the ag space to just over 1.2 million contracts. And that's their largest exposure here in the ag space. In just over a year, index funds, they're holding a record long position in Kansas City wheat futures at nearly 83,000 contracts, and also holding very close to a record long position in soybeans as well, that at 215,000 contracts. Also big buying here by the money managers. They've been net buyers here in the ag space for 7 consecutive weeks. That's now expanded their long holdings to the largest in just over 2 years. Last week, the money managers bought about 57,000 contracts across the soybean complex, and that expanded their position in the soybean complex, largest in over 3 years now.
Lastly, JP, why has gold not been gaining despite the geopolitical situation in Iran?
Yeah, I mean, despite its traditional role as a safe haven, it's been under pressure ever since the start of the conflict. At the same time, we've also seen the dollar perform very strongly, while global equities and bonds have sharply fallen. The conflict in Iran has led to a wave of risk-off sentiment in markets across the globe, and because of its impact on oil prices, traders have also been pricing in a little bit more inflation as a result. This has led investors to choose to favor dollar liquidity instead of holding any other asset, really, as they prefer to sit on cash while the conflict continues on. That wave of demand for the dollar has made it more expensive, or the DXY gone up and made gold more expensive for foreign holders, making holders of foreign currency more expensive for gold. Also weighing on gold has been the inflationary fears as a result of the spike in oil prices. Conflict in Iran does not appear to have any sort of swift end in sight, and that has been triggering alarms across bond traders and markets everywhere. Markets have been pricing back expectations for the amount of easing from the Fed this year. And for gold, which tends to perform better in a low interest rate environment, this has pressured prices. Friday's labor report did add to expectations that the Fed will be easing this year. But following the open this week, markets have or are back to scaling back expectations a little bit. The heightened inflationary fears, in my opinion, have been the ultimate headwind for gold prices. It was picking up a lot of momentum earlier in the year as expectations for Fed easing began to gain momentum. But now with the shocks to energy prices, that momentum is swiftly gone, and gold has a challenging road ahead as long as the conflict and energy prices have this sustained strength. So in my opinion, absent the shocks to energy prices, the conflict would have been very supportive for gold prices, but given the impacts to inflation and the clouded outlook for the Fed, investors have chosen to favor the dollar and sit on cash rather than gold.
Friday jobs report mean for the Fed?
Yeah, so Friday's payroll report showed an unexpected contraction in employment growth and a move upwards in the unemployment rate. Headline payrolls declined by 92,000, while December and January saw a combined downward revision of 69,000 jobs. The headline figure marks a clear cooling in job growth, though the decline was partly driven by temporary factors, particularly a strike in the healthcare sector. The unemployment rate did edge up to 4.4%. That, though, is largely stable and is still suggesting that labor market conditions remain stable, though the uptick still is a little worrying for members at the Fed. Regarding sectors, healthcare did see a loss of 28,000 jobs, which was attributed to labor strikes. Meanwhile, IT, federal government, transportation, and warehousing all saw job declines as well. Hiring for manufacturing, construction, retail, finance was all largely flat. So the only sector that actually recorded a job gain was social assistance. Despite the obvious weakness in the headline figure and the poor distribution of job gains, the headline figure was likely a little overstated by the strike activity, but still, the report was not pretty and pointed to a very bad month of hiring in February. And the report also did reveal a notable sign of weakness in the labor market with a rise in long-term unemployment. That rose to 1.9 million. That's up from 1.5 million a year ago. That's suggesting weak hiring conditions and is attributing to slowing labor demand. So for the Fed, the question more or less is about how fast or slow labor demand is cooling. That's going to be likely the central topic for discussion about timing of the next rate cut. Now, the surge in oil prices also reignited concerns over how the Fed's policy should play out. The unexpected drop in hiring alongside what looks to be building inflationary pressures does present policymakers with a little bit more of a difficult balancing act. This will lend greater focus to Wednesday's inflation figures. Those are expected to show prices to rise by 2.5% on the year in February. As for easing expectations, markets are currently priced for a cut in September and are implying around 39 basis points of easing by year end. So not fully priced in for 2 rate cuts this year. That's been reflective of how the rise in energy prices has reshaped the outlook for the Fed.
Great, thank you all. Remember, the views and opinions expressed today in this video are solely those of our guest speakers and should not be construed as the views or opinions of ADM Investor Services or ADM. If you would like more information about our brokerage services, please visit admis.com.